Okay, looks like fourth time is a charm. I'm not on my better microphone tonight, which is a bummer. Having all kinds of technical difficulties over here. I don't know what the deal is, but that's okay. Hello, everybody. I hope everybody had a wonderful Christmas. And originally, I wasn't going to do anything this week because there's not a great deal of news. I mean, a little bit of noise coming out of Hong Kong, but for the most part, not a whole lot happening in the world right now, as to be expected with the holidays. U.S. stocks, yeah, they did surge today again, as we might expect. Nasdaq now over 9,000 to, 90.22, up almost 70 points today. S&P 3239 up 16 and a half. Dow 28,621 up 105. Pretty big, solid movement in the stocks today. Another pretty fascinating story is crude oil up nearly 1%. Crude trading right now up about 4 cents to 61.72. Not touching crude with a 10-foot pole. And U.S. stocks are going to be the primary subject tonight. 10-year yield falling just a hair right now. Gold prices. Gold surged today, and so did silver. Gold up to 15, 14, 20, down about 20 cents right now, but we've had a pretty good rally in gold the last couple days, so I'd expect a little bit of red on the screen here. Same deal with silver, up to 17.96. I believe at one point we were over 18 on the high today. We got the futures up by 2 3/4 on the S&P right now. The other two are following. The only Asia market we have open right now is the Nikkei, which is down 4 points. Pretty, not even really a significant kind of move. Euro 111.05, really kind of unchanged. We have seen a little bit of dollar weakness, which I suppose feeds into the fact that bond yields are falling. That's all right. So the primary subject tonight that I wanted to go into, since we have this S&P 500 and NASDAQ that are just surging. I mean, all the major indexes, I had that long position. I've had one on for, in my IRA, we're talking here. I've had a long position all year long, excuse me, because of the Fed, printing easy money and da-da-da-da-da. And what happens when the Fed creates liquidity, like I just keep saying over and over again, stocks are going to surge because that's where the money goes. So on that note, being, long stocks and seeing the kind of price action that we have in the market, how do we protect ourselves? Because we know there's a pullback coming. I mean, it's imminent. We don't know when. We don't know how, to what extent. I mean, I have my general ideas now. I mean, I was looking for 31.55. And honestly, I don't think that would be a terrible number if we stay around that area. Technically, we'd still be in an uptrend. That'd be wave 5 off of this price move. We got a setup trend because we did get a 9 on the daily chart of the S&P futures right at another level, which is, pretty obvious, about 30. Technically, it's 3203, but we'll call it 3200 just for simplicity's sake. And they're still rallying, and I'd expect them to rally more, probably. I mean, I wouldn't be surprised if by New Year's Eve we see 3,300 on the S&P. We're coming up to 3,250 right now, and there's just no buyers in sight anywhere. So I'd feel comfortable saying that 3,300 isn't out of the question for the S&P futures. So really the core of this, all right? And on my Facebook post, I said cash settled products. Options and futures and hedging. And these two go hand in hand because a lot of the products that you would use for hedging, at least the really big products that the institutions use, are what's called cash settled. So we're talking options right now, calls and puts. Calls increase in value when the asset goes up because it gives you the right to buy, and puts go up when stock prices or corn, whatever it is you're trading, goes down because it gives you the right to sell. So these products that I'm talking about, and these are ones that I love. I love the index products, and like I've said in the past, the bulk of my trading is S&P. As of late, it's been a little bit more NASDAQ. But I love trading the index options. They give you an insane amount of leverage. And unlike with futures, where you put up a little bit of capital and you can lose more than, so if you say you put up 1,100 to trade a corn future, you can lose more than that. Whereas with options, the only thing that you lose is the price that you pay for the option. And I'm talking long side of options here, because while I do sell premium time to time, I do the bulk of my trading on the long option side when we're talking options. So you have limited risk, and you get a ton of leverage. The ones that I'm looking at the money, all right, SPX weeklies. At the money, generally you can pay between $1,300 and $1,500 in this environment right now. All right, for an at the money, so if the S&P is trading at 3250, this would be a 3250 call or a 3250 put. Okay. And the leverage comes from what this option controls. So one SPX call or one SPX put is 100 times the strike price. So if you're looking at the S&P 500 100 times, I'm going to use the futures for example, but SPX tracks the actual S&P 500 itself, because that's what it is. It's the S&P 500. So the price that you see for the S&P 500, that's what we're talking about here with SPX. So the notional value, or the actual value of the underlying product, the S&P 500 times, is the S&P 500 times 100. So you're looking at about $324,000. Excuse me, $324,700 right now, based on the figure I'm getting from the S&P futures, because they're open right now. Big. For $1,000, you're controlling, well over $300,000 product. And where do we get the $100 from? The $100, right? Since it's an option that expires, for every point that your option is in the money, so for every dollar you're in the money, you get paid $100 in cash. That's the cash settlement aspect of SPX and DJX and the index products. You get paid $100 every point that's in the money. So let's say that you bought the S&P, you bought one at the money call at 3,200 on the S&P. It's trading at 3248 right now. You got 48 points. So you would make how much? $4,800 per contract. That's just for one contract. Now getting 50 points in 1 week in the S&P, it doesn't always happen unless you're in melt-ups like we're in here. But that's the power of options, is the leverage, the amount of money that you can make per contract based on the risk. So if we're using that example and you paid $1,300 for one at the money weekly call, and you're up 48 points, you just made a 500% return, and you don't get that just buying SPY or buying an index fund or something of that nature. And the whole reason that all this leverage is incorporated into these options. And this is where the hedging part comes into play. So you're buying typically, all right, not in my case, I use options to speculate on the price of the S&P 500 or Apple stock or crude oil, whatever it is. All right, but the whole purpose the options were created for was to hedge risk. So if you own, say, a ton of stocks, you own a bunch of Apple, Amazon, Microsoft, GE, Ford, you own a bunch of stocks that are all in the S&P 500. All right. And you're at a place right now where we've had just this massive rally for the last 2.5, 3 months. And you're worried about a correction because it's coming. Like I said, you don't get a move like this, an over 300-point move without getting a little bit of pullback. Even though this market's rigged by the Fed, it still pulls back every so often because people are taking profits. They're selling their futures, they're selling their stocks. So, if you're up, you got a nice profit, you want to take your money and run. So it's coming. So if you want to protect yourself, just like when you buy, say, car insurance, all right, you don't want to go out and pay the insurance company. Say you have a $10,000 car, you don't want to pay the insurance company $10,000 for $10,000 worth of insurance. That's ludicrous. That makes no sense. So if you're paying the net value of what you're insuring, then it doesn't make any sense because you're at break even at that point. So what you do is you go out into the options market and say you have a $100,000 portfolio, and that's an easy number. You want to insure $100,000 worth of stock. Well, guess what you can do? You can go out and buy an SPX put or an S&P 500 put. There's also a NASDAQ one. There's also a Russell 2000 one. There's also an OEX one, which is kind of like the Dow Jones. And then you have the DJX, which is actually the Dow Jones. So you go out and you buy an SPX put for, let's call it $2,000, because puts tend to be a little bit more expensive than calls, because that's what all the big shots on Wall Street that manage billions and the people that manage your 401ks and things, they're managing big money. So the point being, that's what these guys are buying, and for $2,000, which is 2% of your account, you can shake off a little bit of that risk, and balance it out. So say the market drops 2%, we're going to make about that equivalent, if not a little bit more, by buying this option. So instead of losing money, instead of seeing red in your stock portfolio, and actually in this case, you might actually see some green, because when this thing starts to drop, puts go up in value very quickly when the market drops. And I'll explain that after this example. So it balances out these pullbacks. And, we don't know. This could be it. The bull market could be over tomorrow. You really don't know. Just like life, the stock market is all about uncertainty. Nobody really knows anything. So that's why you buy insurance on your portfolio via either puts, if you're a long stock, like most people probably are right now. And the beautiful thing about this, and I do this all the time, is if I have a long, say, bond position or gold position or S&P position, and, I think a pullback's I'll go buy puts, and I'll profit on those puts. I'll make some money on those puts. And as soon as it looks like we're coming down to a bottom, and I can't always explain to you how I know it, I've been watching this stuff for a while, so it kind of makes sense. Even though I'm not a big shot trader, I've been doing this. I'd say I've been doing it long enough to get somewhat of an idea of, big volume spikes, big downside wicks, things like that. Donald Trump putting out a tweet about China. That's been a pretty good indicator. And you sell out that put for usually an enormous profit. I mean, these things double, triple, go up 5 times your investment. Sometimes I've had them go up 10x if you get like a really nasty pullback. And you're buying these out of the money. You don't want to buy them at the money unless you're speculating, because you don't want, like I said, you don't want to spend a fortune insuring your portfolio. So what you can do is, and I don't expect this market to go into a complete crash. Like I said, it could. Nobody knows, but I think this thing will turn around after a little bit, a nice little healthy pullback. So I can take the profit from that put, and I can go out into the market and buy more stock. I can add to my long position, or I can just keep it in cash, and I can use that for another opportunity, or maybe I just want to have a little bit of cash. So that's the power of hedging. And hedging, a lot of times, because most investors are 401k people, and I'm not bashing 401ks. It's not what I'm out here to do, act like I'm better. I'm not. Some people just can't handle this. And this is a stressful game, and you got to have a stomach of steel, as I've learned to deal with this sometimes. And, some people are busy working, busy with their life. They don't want to sit here and look at charts. So, they don't go through all this. But if you are self-directed and you play with your own money, this is something that you really should consider, and I don't know if this is the top. I don't know if it is, but in my opinion, after we have a massive rally like this, I want to be protected. My IRA, my brokerage account, that's a different story. But in my IRA, where I'm more conservative and I don't take massive risks, I don't want large drawdowns. I don't want to lose a lot of money at one time in my IRA. And we're lucky enough that we have self-directed Roth IRAs nowadays. Contact your broker. They can give you more information on that. I'm not a financial advisor. And when it comes to the details of those products, that's better left to the professionals that deal with, 3-letter account names, bankers, and all those kind of people. But you have the option to do things like this. And there's another strategy too, actually, for hedging. I don't like this one quite as much, but this is something that is actually a strategy you can constantly have on, is you can sell call options, all right, which gives you the same exposure as buying a put option. Because when the market goes down, remember, when you own calls, you want the stock or the commodity or the index, you want it to go up. You make money when the price of the asset goes up with the call option. It's now when the price goes down, the call options deteriorate in value. They fall apart. So what you can do is, when you're selling options, and I haven't talked about selling options on here. I probably should. I'm just not necessarily as big of a fan of doing it. Like, if you're trying to grow an account, I think it's a great way to generate income. And they call it options income trading, but I don't think it's a great way. But this one, for hedging purposes, I think it's a great way to hedge your portfolio if you want to be a little bit more conservative. Because what happens is, instead of having to buy a put and use capital, if you have, let's say, and this is something more common in when you have stocks, like when you own Apple, because stock options actually settle into 100 shares of stock, unlike something like SPX that settles to cash. When you have a call option with Apple and it's in the money and it gets exercised, now you have 100 shares of Apple. So the difference here with selling the call is that you're selling it, you're getting a credit, you're getting money put into your account. So instead of having to pay money, you're getting money. And some people prefer that more because you don't have to put up capital, and I get that. And with options, you have this time aspect, which, if you like buying, like speculating with options, it can hurt you sometimes. It brings you down when you own them, but when you sell them, time decay, or theta, which is the big fancy Wall Street word for it, is on your side. So over time, because you're going to be selling that option out of the money. So stock price is here, you're going to sell the call here. Stock price goes down, the price of that thing gets killed. All right. So you have, when you're expecting a move to the downside, you get the price reaction. All right. So that thing's further from the money, so it's worth less. And over the time of the pullback, that thing's going to get eaten up by time decay, depending on what time frame you sell it at. So that's also another strategy for hedging, which I don't prefer as much. Now, there's one more, and I think this is more of a institutional play, but you can go into the futures market, and there's futures on the major stock indexes as well. The S&P 500, which is the ones that I talk about all the time, which is ES or E-mini S&P 500 futures. These are half the size of the SPX. You're looking at a $50 tick. So you have a $50 multiplier instead of a $100 multiplier. So it's half the size. So you're looking at about $160,000 notional on the big ES. I shouldn't say that because they still trade the big S&Ps, which are 250. Not as much. You got to go into the pit guys in Chicago do those. And so you have this option as well. But the thing about futures is that they're dynamic. It's just like buying or selling a stock. The only way you make money is with price movement. So if you're selling a future against your stock position, the only way you make money is if it goes down. If it stays sideways, flat, it doesn't go anywhere, which there can be some upside to that. But futures are a lot less dynamic. And the only way you make money is by getting the direction right, which kind of hinders your probability of success sometimes. That, and I think the return with options is far greater. That's why I like them better. When I'm focused more on making an income, like for a living or longer term positions, futures are great. But for speculating short term, my opinion, I think options are better. That's just me though. And that depends on which product. It's mostly a function of capital efficiency. So how much capital you have to put up to control one unit, whether it's one future contract or it's one option contract. Now, these stock index futures, much like the SPX or the OEX, any of that, these settle to cash as well. So it's pretty much the same concept. If you got 50 S&P points at the expiration of the contract in your favor, when it expires, you just get paid, however many points you have times 50. That's all it is. If you have 10 points in your favor, and that contract expires, you would make $500. Same idea, because with a stock index, there's nothing there. It's not like crude oil. You don't get 1,000 barrels of oil. You just get cash. Because, these were exclusively created for hedging portfolios. Now, the other kind of options, and I should go into this too, are the physically settled options. You have the cash settled, which is the SPX, which is the OEX. S&P 500 is the official name for that one. That one doesn't trade as much. The DJX, which is the mini Dow Jones. The XSP, which is the mini S&P options. And then the NDX, which is the NASDAQ options. Those all settle to cash. You have the S&P 500 futures settle to cash. You have the NASDAQ 100 futures, which I love trading options on those. That settles to cash. You have the mini Dow Jones futures settle to cash. Now, stock options, the only difference is at expiration, they settle into 100 shares of stock. So instead of getting paid for whatever the difference is with the index options or the index futures, you're getting 100 shares of stock that you have to buy. All right, so if you're buying, what is Apple at today? I should know this because I trade indexes, and Apple's the biggest in all of them. Okay, so you have Apple at $289.91. Let's call it $290 a share times 100. You're going to have to pay $28,900. $29,000, sorry, going to the 290 per share. And you have to buy that with cash that you have in your account. And so if you're going to exercise them, you don't just get a payday. If you're going to exercise that option, and I need to clarify this, if you're going to exercise that option, you have to buy $29,000 worth of stock. Now, with options, you have the luxury where, because you have the right and not the obligation, unlike futures, you don't have to take delivery of the stock. But that's how they settle. They don't settle in the cash. Now, if you're hedging stock, with calls or puts or what is, depending on which side of the market you're on, that makes sense. But if you're just speculating, I think the cash settled products are so much better. They're so much easier. You don't have to worry about getting assigned any of it. I mean, it's simplicity, and that's what I like about the index options. That's why I prefer them. That and I don't really trade a lot of stock. I have stock at my IRA, but aside from that, I don't trade stock. I trade derivatives. I trade options. Occasionally, I'll trade futures if I'm hedging an options position, but that's it. And that's just a matter of preference. Some people trade stock, some people trade commodities, some bonds, whatever it is that you do. If you're doing good at it, hey, more power to you. But that's just how I prefer to operate. And those are some of your options, pun intended, that you can have when we're coming into one of these giant price extremes like we have in all the major indexes with a lot of the major stocks. And that's a way that you can protect yourself against having a big drawdown and actually making some money while this thing's going down instead of just sitting on the sidelines and scratching your head and trying to figure out what to do when the stock goes down. Like I said, I love recycling those profits back into the position that I'm hedging. All right, so from there, we're going to wrap it up. S&P coming up actually a little bit, up 4 now. I got positions in S&P expiring tomorrow. I got bond positions expiring tomorrow. Tomorrow's expiration date for bonds, so I think we could see a little bit of volatility in the entire spectrum of the bond market. What else is expiring tomorrow? Natural gas is expiring tomorrow. I believe gold and silver expire tomorrow too. I'm not sure about crude. I'm not sure about soy. Actually, I think the whole CME suite, if I'm not mistaken, expires tomorrow. So we'll be going out, to end of January, options on all the major commodity products. So from there, I'm going to go ahead and wrap it up. That's about it. Wait a minute. One more check of markets before I call it quits. Shanghai in China is now down, is only down 50 cents. Shanghai, or the HSI, is up 170 points, 28,033. Nikkei, not really doing a whole lot. Still down about 10 points. U.S. stock futures are S&P up 4, Dow up 36, NASDAQ up 21. Looks like we're getting a rally into the end of the week. And I may be with you tomorrow. I don't know. As things develop, I'll be on here as much as possible. We'll talk about hedging, talking about shorting this market, and all the other things that are involved. So, from Naples, Florida, Vincent Freeze for the Naples Vice channel. Have a good evening, everybody, and let's make some money.